Today I'm looking at the Ftse 250 and also looking at the UK macro landscape. Before I start, please remember that I only do these videos for fun as a hobby. Always speak to a qualified financial advisor before making any investment decision. So what's apparent when looking at the long-term trends for the Ftse 250 is that ever since using its new Keynesian economics methodology, where the central banks use interest rates and quantitative easing to help meet their objectives of 2% inflation and roughly 2% GDP growth per year and low unemployment. Ever since we embarked on full blown new Keynesian economics, we've seen an increasing gradient in the Ftse 250. But as I covered in last week's video, in the US we still have high interest rates and actually a cutting back of quantitative easing. But the S&P 500's been on a massive rally. Whereas in contrast, if we look at the UK, we still have relatively tighter interest rates and actually moderate quantitative tightening. But the Ftse 250 really has lost its way. What seems apparent to me is that according to the new Keynesian economics model, we really need to start lowering interest rates in order to get back on track again. Actually, the reason why the US has seen significant growth in terms of their stock market over the last year, despite not loosening their monetary policy, is I think more down to two reasons. One is that the US has extremely good hydrocarbon reserves and is now a net hydrocarbon exporter, whilst the UK has run out of oil and has become really an energy peasant. On top of this, if you look at the stocks that make up the S&P 500, these are actually all the cutting edge technology companies which are leading the world. These are the greatest, newest businesses. And so I think the success of the S&P 500 actually has more down to the hydrocarbon wealth of the US, plus that the US has the best, most cutting edge companies. It's got more down to that than anything else. In contrast to that, the UK also has relatively tight interest rates. The difference for us is that our economy is really struggling now that our oil and gas is running out. When you look at the composition of the Ftse 250, we see that a lot of the constituents may have been businesses that were cutting edge 100 years ago, but generally it's more of a second-rate, second world economy compared with the US. Another interesting thing is that the Ftse 250 is dominated by investment funds, particularly sensitive to interest rates and quantitative easing. So I think that actually going through this macro review for the UK, it's given me an extra insight on the US, the video for which I did last week. And I kind of now understand the US benefiting from the quality of its stocks and also the hydrocarbon wealth of the US, explaining why it can still continue on a good trajectory despite keeping things still in terms of the central bank measures. However, looking at the UK here, we are more dependent really on this new Keynesian economics model. And so unless we were to do more quantitative easing or low interest rates, the current decline of the Ftse 250 really does make sense. And so it's therefore very important now to take a look at the macro to see, will the central bank be in a position to lower interest rates? So like I said before, the central bank can use interest rates and quantitative easing in order to try and meet their objectives of 2% inflation, 2% GDP growth, and low unemployment. However, it's only able to use this NKE because in a privileged way, because unlike a lot of other countries who wouldn't be able to do all this money printing and stuff without going completely bankrupt, we have a bit of liberty of doing that without destroying the pound sterling. because it's used as the reserve currency for 5% of all reserve currency holdings. And also because of a certain level of confidence in the UK above a lot of other countries in the world. This allows us a certain amount of government debts and fiscal deficit. But these are good measures to keep track of, because the moment the government starts to get too much in debt, that will then endanger the pound sterling, and then affect the bond markets in a way that will just completely unravel this new Keynesian economics model. Another thing is there are forces which have also allowed some governments to get away with all this money printing and having near zero interest rates. And these are mainly the growth of the internet, technology, and globalization. So these have been very deflationary forces that have allowed all this money printing, but these forces weren't around in the previous century, and they're kind of like a new thing which has enabled this behaviour, which has been quite successful at keeping GDP growth fairly stable over the course of time, and also greatly benefited the stock market. There have been inflationary forces as well, which counter these deflationary forces, and I kind of summarise this here. I won't go into too much detail about all this video, but it's just important to know that this behaviour has been enabled by certain phenomena, particularly new technology and globalisation. So to look at the pound sterling then, of course, before the Second World War, the pound sterling was the numero uno reserve currency in the world, but the moment we lost our status as a global superpower, the pound sterling has been in a terminal decline. But it's actually kind of stabilized. After the financial crisis, that led to a massive, a massive weakening of the pound sterling. But it's kind of stable at the moment. But we've also got to wonder if the government was to start getting a bit too laissez-faire as a response to this crisis. Could you see a repeat of this, which would be very detrimental, I think, for what the government can and can't do, and for our economy. But for now, the pound sterling is fairly stable. Here I've got the Japanese yield curve, which is how yield curves are supposed to look. And here we have the UK yield curve, which is of course inverted. And there's been a lot of noise about us having a inverted yield curve, and so therefore, where's the recession and where's the stock market crash? Well, actually, we are technically in a recession at the moment. We've had 2 quarters of negative GDP growth. So indeed, the UK is in a recession. So you could say that the inverted yield curve has been successful in predicting a recession. The question really is can the UK government now reduce its interest rates at the low end? And through this, you can see the mechanism by which we would return to a normal looking yield curve, which would then presumably be maintained. And then as we moved further and further into recovery, it would keep the normal profile that you'd expect in a yield curve. It's just that actually the percentages on the left here would lower and lower as confidence in the UK increased. But actually, if you look at interest rates historically, where they are now is a normal number. So you could see the government perhaps lower them a bit to say 4%, and then with the embattlement of the UK government's finances, maybe you see them actually going up a bit at the long end. And again, it's quite plausible here how we can come out of this recession and the yield curve can correct to a more normal profile. So one thing that affects the yield curve and the ability of the government to lower rates is the strength of the government finances. And we have government debt currently of 2.6 trillion, which is 97% of GDP, and fiscal deficit of 0.2 trillion per year, which is about 6% of GDP. And these look like horrific numbers, but when I map them out against historical data, we see that compared with 2019, the situation definitely is worse, especially in terms of the fiscal deficit. But it seems to be moderating a bit, and it seems actually fairly stable. We see here the government debt versus GDP, and we see how the government actions following the Wuhan outbreak definitely did make us worse off by a good 20% or so, but it's kind of appears stable. And here we look at the government receipts versus spending, and again you see after 2019 the books are not balanced. You know, we're spending more than we take in taxes every quarter, and you can see that here with the net quarterly fiscal budget surplus or deficit. There's a step change. The government actions of during the pandemic really has, in a step change, put the UK government in a situation where it really is spending more than it makes in a kind of step change here. So the pound sterling does seem to be embattled a lot by the poor state of the government finances, but it's kind of stable. And you've got to think, of course, relative to other currencies around the world. So it's definitely embattled, and these issues, for example, the government won't be able to lower taxes or do lots of extra spending to try and revive the economy as much as it might like to, because we are significantly hobbled here a bit by our government, which really starts to resemble some kind of socialist republic in terms of this fiscal indiscipline. Here, onto that point, you see government spending as a percentage of GDP, how much it's steadily increased, and we find ourselves, you know, not with the kind of free market that I'd like to live in. And here's retail sales, which I slip into this segment, but this is interesting because you see the value of goods has continued to go up, but if you look at the volume of goods sold, that's decreased. So here we have classic recession. Actually, the inflation caused by the government's COVID policies, that means that now everything's more expensive for everyone in a kind of in a permanent manner. But we're in a recession, and you can see that because the amount of goods changing hands has reduced. And so this data confirms quite nicely the GDP data to prove to us that yep, we are in the middle of a recession. So to look at inflation, although a lot of people like to use the year-on-year numbers or headline inflation, I don't find that very useful data because it goes back a whole year. And so I prefer to look at the month-on-month CPI, and then I plot that into quarterly bundles to give me a better, more of a real-time idea of what's happening with CPI, and better data for medium-term trending. And we clearly see that perhaps thanks to this recession, inflation is dropping in the UK. And following the numbers of monthly CPI actually trending down, as you can see, last year, we actually got a negative 0.4% print in January. Now that's only one data point to go on for my quarterly plots. So you've got to bear in mind that's only one data point. And I can kind of see it being perhaps at zero when we get the next two months data. So we clearly do see that the inflation problem has gone away and is about zero. So by my little calculation I do, which I explain down here, I've predicted that we'll have zero inflation this year based on the most recent quarterly data. And then in terms of GDP growth, we don't have any data for January yet. But like I said, we're in a kind of mild recession territory here. And I predicted a 0.4% number for the end of the year based on how I calculate. So with inflation at zero and GDP in slight contraction, there really is a good argument here that the central bank will be able to lower interest rates a bit to help stimulate the economy. The only thing is the pound sterling is embattled, but then actually going back to the yield curves, it does kind of that does actually support quite nicely the idea of the low end of the short end of the curve seeing a reduction in interest rates, but probably only to like 4%. But then, because we now live in a socialist republic, the on the long end it should increase. Looking at unemployment, and this is the one miracle of recent years, is that just how low unemployment is. And reading into that a bit, I can't help but wonder: is this the effect of demographics now? Is it that there's a lot less younger people in the population, and so that's led to lower unemployment, and that's certainly a good thing. And then house prices, well, house prices kind of stood still last year overall, and we've just had two positive prints for house prices this year. But when I look at the long-term trend here, I couldn't help but wonder: are we seeing house prices trending downwards actually when you look at it in this scale? And that would actually make sense because it's well established that normally in a recession, you have the stocks crash first, which they've done. Then you start seeing the GDP growth go down and drop in inflation, which we've seen. And we're definitely in the middle of a recession. But then the last domino to fall, traditionally, are house prices. So given that we're in a recession, I really would expect to see house prices drop as we move towards the end of the recession. And then by the time the house prices are bottoming, by then you should actually see the stock markets in full recovery by then. So unlike the US, which has been saved by being an absolutely massive hydrocarbon exporter, doing lots of fracking too, and having some of the best companies in the world, the UK unfortunately hasn't been able to escape a recession. This explains the drop in the FTSE 250. But then thinking about what happens next, I found myself in a real deja vu moment where I was actually thinking back to the credit crisis, and I can remember in 2009 seeing Mark Farber, seeing Jim Rogers and Peter Schiff on Bloomberg saying that Armageddon was here, there was going to be a massive stock market crash. And I actually really bought into that back then, and I missed out on a number of years of really good growth in the stock markets back then because of these doomsayers. But I've got a real feeling of deja vu in that when you think back to 2009, we were kind of in the middle of a recession then. But of course, what I could say I learned from then is that the stock markets lead the economy. So I really do feel that the FTSE 250 probably has bottomed now with this lovely double bottom actually. And I think that although it's going to take us a while, probably till next year, to be fully out of this recession, with the house price crash being the kind of final innings of that. I do actually feel that we're going to see a return to the old trend of a increasing stock market in terms of the FTSE 250. But for me, the question is, will it be a return to the same gradient as we enjoyed before this recession, or has the UK government managed to damage the economy enough, particularly with things like its energy policies, that we're going to have a hobbled economy moving forward and a slower growth rate, which I've called the Little Britain scenario, which would actually be a sluggish growth pattern that would be quite befitting our new socialist republic under the Labour Party. So I currently only have 10% of my portfolio invested in British stocks, and I may be interested in increasing that later this year. It would be good to see this play out a little bit more, but I am actually expecting the FTSE 250 to recover now. Now that we're kind of dead centre in the middle of this recession, or perhaps a bit towards the end. But when I start investing in the UK, I'll be picking my sectors very carefully, and also I'll be trying to pick stocks with lots of international exposure. So that completes my video. I hope you enjoyed watching it as much as I enjoyed putting it together. Good luck with your own investment journey.
I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.